Welcome back to Factful Finance, the place where we turn complex financial concepts into powerful tools for your success. Have you ever wondered how some investors seem to make money no matter which direction the market moves? Well, the secret might just lie in the world of options trading. And today, we're diving into the mechanics of calls and puts, two powerful ways to profit from market movements. Options trading can seem like a mysterious and intimidating world, but it doesn't have to be. With the right knowledge, you can harness its potential to boost your portfolio. But before we jump in, let's set the stage. According to the Options Clearing Corporation, over 20 million contracts are traded daily. That's no small number. Options trading is big, and today we'll break it down so you can decide if it's right for you. Now let's start with the basics. When we talk about options, we're referring to a financial instrument that gives you the right, but not the obligation, to buy or sell a stock at a predetermined price before a certain date. This right can be a powerful way to hedge your bets, or, if you're more daring, to speculate. There are two primary types: calls and puts. First, let's talk about call options. A call gives the holder the right to buy a stock at a specific price, called the strike price, within a set time frame. Think of it like reserving a table at a restaurant. You pay a small fee now, the premium, and if the restaurant gets busy later, the stock price goes up, you can still buy that table at the price you agreed on, no matter how much the demand increases. But here's the key. If the stock price goes up above your strike price, the value of your call option increases. You could sell the option for a profit, or if you're feeling bold, exercise it and buy the stock at that lower price. This is how investors profit from the upward movement of stock prices using calls. Now let's flip the script with put options. A put option gives you the right to sell a stock at a predetermined price before a set date. This is often used if you believe the stock price will drop. In essence, you're betting that the stock will go down. It's like an insurance policy for your portfolio. If the price of the stock drops below your strike price, the value of the put option rises. So just like an insurance policy that pays out if something goes wrong, a put option could allow you to sell the stock at a higher price than what it's worth in the market, securing a profit. But it's important to remember, options aren't for the faint of heart. They involve leverage, which means they can amplify both your gains and your losses. So while the profit potential is enticing, managing risk is critical, and that's where strategies come in. For example, a common strategy for beginners is the covered call, where you own the stock and sell call options on it, generating extra income. On the flip side, you could use a protective put to hedge against potential losses on a stock you already own. Let's take a real-life example. Meet Liam, an investor who owns 100 shares of XYZ Corporation trading at $50 per share. Liam believes the stock will rise in the next 3 months, but wants to generate some extra income in the meantime. He decides to sell a call option with a strike price of $55, collecting a premium of $2 per share. If XYZ doesn't go above $55, Liam keeps the premium as profit. If XYZ rises above $55, Liam might have to sell his shares at $55, but he still makes a profit from the premium plus any gains up to that price. The lesson here? Options trading is not just about predicting where a stock will go. It's about using tools to manage risk, enhance returns, and create multiple ways to profit. But just like any financial strategy, it's crucial to understand the ins and outs before jumping in. Now, here's the catch. Like any financial tool, options carry risks. You could lose the entire premium you paid for an option if the stock doesn't move in the direction you hoped. In fact, according to data from the Chicago Board Options Exchange, about 75% of options expire worthless. That's why proper risk management and having a strategy in place are key to succeeding in this space. So should you dive into options trading? Well, if you're looking for more flexibility, greater profit potential, and you're ready to manage the associated risks, options might be right for you. But always remember, this content is for educational purposes only. Mentioning any apps, products, or services is not an endorsement. Always consult a certified financial professional for personalized guidance. Which option strategy intrigues you the most? Are you ready to make your first trade, or do you have more questions? Drop them in the comments below. and I'll be happy to dive deeper into your inquiries. And if you found this breakdown useful, don't forget to hit that like button and subscribe. You're not going to want to miss the next financial breakthrough we uncover together. If you're looking for even more insights into strategies that can take your financial game to the next level, click the video on screen now. Let's keep the momentum going.